Welcome to Voice Daily Finance, the most important news personalized for you every day. Supported by Voice.com.
In today's episode, you'll learn about, first, heading into today's open, futures flash green, but a violent rotation brews beneath the surface. Watch for the opening bell to reveal if mega cap tech can hold the line or if a small cap surge triggers a market-wide regime change. Second, Buffett's historic 5.5 million % run ends, but his $381 billion cash hoard triggers alarm bells. The king's reign is over, but his final move, a massive cash pile-up, is a stark warning. With the Buffett put gone, is the market now flying without a safety net? Finally, Apple giant stumbles. Vision Pro production plummets in a shocking defeat to Meta. This isn't just a product failure, it's a high-stakes war for the future of computing. Is this the moment a cheaper rival topples a tech king, and what does it signal for the entire premium market? Quiet on the surface, but smart money is arguably screaming under the water. The S&P 500 might be flashing green to start the year, but the leadership structure that defined the last 3 years is actively dismantling itself right before our eyes. While headline sentiment appears optimistic, the internal dynamics of this market suggest we are standing on a fault line between a historic valuation bubble and a necessary regime change. The S&P 500 opened 2026 gaining 0.56% to hit 6,884 points, and on paper, it looks like business as usual. But do not let the headline number fool you. Trading volume remains thin due to the holidays, and beneath that index level, we are witnessing a violent rotation. The Nasdaq Composite is struggling to hold ground, having declined in the final session of 2025, while capital is quietly but aggressively flowing into areas that have been left for dead since 2023. The divergence between the indices is the story today. Why is this rotation happening now? The primary driver is a structural collision between perfection price valuations and a deteriorating macroeconomic reality. We are currently staring at a Shiller-Cape ratio of 39.4. For context, that is the highest level we have seen since the dot-com bubble in 2000. When valuations are this stretched, the market demands perfection, yet the macro backdrop is far from perfect. From a policy perspective, the Federal Reserve is signaling a pause. Markets that priced in aggressive easing are waking up to a reality where rates might stay near 3.5% to 3.75% for the long haul. This is largely due to the new tariff regime averaging 16.8%, which creates a structural inflation floor. If inflation ticks up as tariff costs pass through to consumers, the Fed's hands are tied and they cannot cut rates to save a slowing economy. This creates a bimodal growth outlook, a strong first half of 2026 driven by tax refunds, followed by a sharp deceleration in the second half as tariff drags accumulate. This trajectory is forcing a massive capital reallocation. The easy money trade of blindly buying mega cap tech is evaporating. The divergence between the S&P 500 and the Russell 2000, the index tracking small cap stocks, is the loudest signal in the room. Small caps have rallied 11% since mid-November, while the Magnificent Seven have lagged at just 5.5%. This is not a glitch. Analysts suggest it is a feature of a market pricing in a regime change where value finally matters again. Let's look closer at the Magnificent Seven because they are no longer trading as a monolith. The divergence within this group is telling. Nvidia and Alphabet remain the outliers, holding up due to tangible earnings visibility from AI infrastructure and search dominance. However, we are seeing technical weakness in Apple and Tesla, both finishing December in the red. Microsoft, despite its quality, is facing questions about massive capital expenditure returns. The market is beginning to ask the hard question: will hundreds of billions in AI spending actually translate to profits in 2026? So where is that capital going? Financials and value. The Financial Select Sector SPDR Fund, or XLF, is trading at 12 to 14 times forward earnings compared to the broad market's 20 times. With the 10-year Treasury yield stable near 4.14%, net interest margins for major banks like JP Morgan Chase are stabilizing, creating a genuine earnings growth story that is far cheaper than tech. Energy is also back on the radar, with oil prices hovering around $60 per barrel and OPEC Plus meeting shortly. The downside risk appears limited. This makes the sector a potential hedge against the very inflation risks threatening the tech sector. The market rhythm has fundamentally shifted from a momentum game to a valuation game. The next few weeks are critical. We have the FOMC meeting at the end of January and key inflation data shortly after. These data points will determine if this rotation accelerates or if recession fears take over completely. The smart money is watching the spread between small cap value and large cap growth. That is where the real story of 2026 is being written. Let's start with a number that almost sounds fictional. A 5.5 million % return. That staggering figure marks the end of an era as Warren Buffett officially hands over the CEO reins of Berkshire Hathaway to Greg Abel. Over 6 decades, Buffett transformed a small textile company with shares at $19 into a global powerhouse, where a single Class A share is now worth over $750,000. His compounded annual gain of nearly 20% almost doubled that of the S&P 500 index since 1964. But as Buffett says, he is going quiet. A massive question looms over the market. The new leadership inherits a record $381.6 billion in cash. This war chest was built as Berkshire became a net seller of stocks for 12 consecutive quarters, a rare and sustained retreat that signaled Buffett's caution. And this massive cash pile is what's really grabbing the market's attention. You see, Berkshire's cash level is often seen as a leading indicator. Research shows that as Berkshire's cash as a percentage of its total assets rises, it often means the most patient investor in the world sees few attractive opportunities. Right now, that cash has swelled to over 30% of assets, while the S&P 500 is trading at a high forward P/E ratio of over 21. So as the market opens, the question is how this signal is interpreted. When a whale of this size actively reduces risk, it makes you wonder if other investors are overexposed. One shareholder put it bluntly, saying, if it was that easy to do again, somebody would be doing it. Now, all eyes are on what happens next. The fate of Berkshire's $300 billion public stock portfolio is an open question, with no clear successor possessing Buffett's track record. Now, an underlying risk that's surfacing is the potential for something called a conglomerate discount. This is where the market values a diversified company for less than the sum of its parts. Buffett's reputation created a premium, but that could now fade. We're already seeing Berkshire's price-to-book ratio, a key valuation metric, slip from its highs. A widening discount could invite activist investors to pressure the new leadership to break up the company, causing major ripples for its holdings and the industries it dominates. Another possibility is a strategic pivot. At the open, look for clues about the new direction under Greg Abel. His track record running Berkshire Hathaway Energy involved bold acquisitions of private companies. Interestingly enough, a pivot like that from America's most iconic investor would signal declining opportunities in public markets and would test a new model for navigating complex geopolitical risks, including China-US trade dynamics. This transition creates a new uncertain dynamic for one of the market's most influential companies and its major holdings like Coca-Cola and American Express. And in a final warning, Buffett himself wrote that the company's stock price will move capriciously and could even fall 50%, as it has 3 times before. This all points to the potential loss of the so-called Buffett Put. Historically, during crises like 2008 and 2020, Buffett's public statements acted as a powerful stabilizing force. His reassuring voice essentially acted as a put option for the market. With him going quiet, that psychological backstop is gone. The absence of his calming influence could amplify future sell-offs, making his warning about a 50% drop feel much more immediate. With a new CEO at the helm, investors are watching to see if that volatility defines Berkshire's next chapter. Speaking of uncertainty facing market titans, it seems another giant is staring down a very different kind of challenge. A rare and dramatic commercial flop appears to be unfolding for Apple. Overnight reports claim the tech giant is slashing production of its much-hyped Vision Pro headset, the device once hailed by CEO Tim Cook as the dawn of spatial computing. The reason? A stunning lack of demand. But that's not the whole picture. The Vision Pro struggle may be a major signal about a demand ceiling in the entire premium consumer market. It all comes down to a classic economic principle, price elasticity. If even Apple, with its immense brand power, can't convince consumers to buy a new, non-essential product at such a high price, it raises red flags for all luxury and premium brands. Actually, recent data backs this up, showing even high-income consumers are becoming more price-sensitive, with a growing number shopping at discount retailers. That's a trend to watch. At nearly $3,500 per unit, market researchers estimate Apple sold a shockingly low 45,000 headsets last quarter. In response, Apple has reportedly cut its marketing for the device by a staggering 95%. This isn't just a stumble, it's a full-blown retreat. The situation presents a fascinating duality. Apple's premium device falters, while at the same time, Meta's much cheaper Quest headset has quietly cornered 80% of the market. This is a textbook example of what Harvard Professor Clayton Christensen called disruptive innovation, the idea that a simpler, more affordable, good enough product can beat a technically superior but much more expensive one. By targeting the mass market, Meta's Quest has captured the user base, because for new technologies, price often matters more than perfection. Now, even Meta is reportedly shifting its focus away from the metaverse and towards AI-enabled glasses. Here's where it gets interesting, because this pivot signals two massive underlying trends. First, it suggests the next major computing platform might not be fully immersive, virtual reality, but rather ambient intelligence, AI-powered assistance seamlessly integrated into our lives through less intrusive devices. Second, this shift is being accelerated by an R&D crowding out effect. The generative AI boom is pulling resources away from other long-term bets like the metaverse. Venture capital funding for AI is at a record high, while investment in the metaverse has plummeted. This situation has echoes of the ill-fated Google Glass, where users were once shunned as social pariahs. An analyst from Morgan Stanley bluntly summarized the Vision Pro's problems. The cost, the comfort, and the lack of native apps are why it never sold broadly. However, if you zoom out, you'll see another layer to this, the ripple effect on the global supply chain. The production halt directly impacts Apple's key Chinese supplier, Luxshare Precision, which made huge capital investments for this product. This failure serves as a stark warning about the risks involved, stranding capital, and potentially accelerating the search for manufacturing hubs outside of China. For Chinese-speaking audiences, this is a crucial case study on the vulnerability of suppliers heavily reliant on a single client's new product success. This all sets the stage for a critical test at the opening bell. While Apple's iPhone and Mac sales remain strong, this highly public failure represents a significant crack in the company's armor. Watch shares of Apple, ticker AAPL, as traders react. Look for reactions in Meta, ticker META, to see if investors reward its pivot towards more practical AI wearables. Also, keep an eye on semiconductor stocks, perhaps through an ETF like the VanEck Semiconductor ETF, ticker SMH, as this platform shift will have long-term consequences for chip design and demand. Finally, for investors in China's A-share market, watch suppliers like Luxshare Precision as the market assesses the financial damage.
That's it for today on Voice Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.